Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. It's October 31st, so happy Halloween, everybody. And in the spirit of that holiday season, I want to talk about some of the scariest sounding tools on Thinkorswim charts. We're going to be looking at things from a bearish perspective, from dark cloud covers to death crosses. This one, by the time we're done, we're going to give our chart an ulcer. So I think it's going to be a fun discussion. Before we get to any of that, though, we first of all say hello to everybody who's chatting in out there in YouTube. Always nice, even on Halloween, to see so many familiar names. Hello there, Paul and Jim, Josie, Lola, Sharon, David, Jay Richardson, Scott, Hope, Frank, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy the recording. I do like to say that's a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Friday webcast series. And we kick things off promptly each Friday at 1 Eastern time. Now, I also want to let my live audience know that my very good friend Kevin Horner is hanging out in the chats with us. Kevin's going to be monitoring the chat questions. And if he notes that there's a chat that's come in that I don't get a chance to review on camera, he's going to assist with that. So thanks for helping out, Kevin. And Kevin and I would like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite Schwab presenters there on that platform. It's a great place to connect with us in between these live streams. You can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. Now, I've also been letting people know that just within the last couple of weeks, you can now connect with me on LinkedIn. So just look for Cameron May. You'll see me sitting right in front of a Scottish castle. So connect with me there as you reply to my posts, either on X or on LinkedIn or both. I'll try to reply right back to you. It allows for some interaction. It's not otherwise available when the streaming's not going on. So let's get into this discussion. Of course, as we dive into these kind of spooky indicators, they carry risks along with essentially every other approach to trading and investing. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment or research, and investing involves risks, including the loss of principal. Okay, so let's set an agenda for today's discussion. This webcast is part of an ongoing series, so we have some example trades that are already in place. Well, one right now, one that closed out since we last talked. So we'll talk about both of those, follow up on those. Then we'll look at the markets through our trend value momentum strategy set that we use from week to week. And then we're going to be talking about these spooky technical indicators. At least they're spooky sounding. There are some ominous sounding indicators on Thinkorswim charts. So I'm going to talk about 3 or 4 of those, and we're going to be planning and placing a bearish trade. Actually, I won't be executing the bearish trade today, but at least talking through the concept of it. So I think this is going to be a great discussion. Let's go right to it. We'll have a look at our existing position. First, we have Apple, 20 shares purchased last week using the Gator oscillator. If you weren't here for that discussion, by the way, or if this is your first time in these webcasts, make sure that you're subscribed to our Trader Talks channel on YouTube. So Trader Talks Schwab Coaching Webcast is the channel name, but this is where you can join our live streams. You can also find our playlist for previous webcasts. So for example, for this advanced charting series, we can scroll down about to the middle of this list of webcast series. There's our advanced charting techniques. And I'm going to click on view full playlist, and you can see it wasn't last week. Ben took over for me last week. I took last Friday off. I had a long weekend. So it was the week before, building a non-discretionary trade system with the Gator oscillator. So let's see how that has treated Apple. Going to our charts. First requirement here is that we had an upward sloping 100 period simple moving average, and we had that. The second requirement was that we saw the jaws of the Gator narrowing. We see that right here. And then we started to get a signal. Took that signal right there. The last time was October 17th. And you can see it's been a pretty cooperative move on Apple, pretty cooperative market move in general. In any case, we're now looking to sell on a second mixed day, combination of red and green bars here, after at least two greens. So we haven't seen two complete greens yet. We saw one, but not two. So we're still waiting. So I'm going to let that one continue to work. Next up, our Boeing trade has concluded. So let's load that up here. Load up our study set for this. Boeing Chandi Momentum Oscillator. There we go. So we entered this on the evidence of the Chandi Momentum Oscillator reaching down into an oversold condition and starting to strengthen out of that. Entered right here with the hope that as the indicator rose toward the zero line, price would match that. In this case, it didn't really do that. More oscillated sideways. Now, what should have happened, because we make all of our trades while the camera's on Fridays, I limit myself to just that. It hamstrings the trading timing to some extent, but I like you to be able to see what we're doing as we're doing it. So had I been here, we would have exited last Friday because our plan was to exit on a crossover of that zero line. We got that, and we would have executed on that last week. However, I was out. Ben took over. He had his own agenda, which is what I encouraged my subs to do. In any case, should have exited here, but I took a day off, so this happened. Yep, yesterday we had a continuation of a strong move that started after we missed last Friday, and we were stopped out. So that trade ended unprofitably. If we go to our account statement and we look back over the last, really just over the last few days, let's look back over the last 5 days, specifically for Boeing. We'll see our trade. There it is. Sold those shares, 208.19, hit the stop. So that one's concluded. Michelle says, what's the name of your, Michelle, you say your indicator. I don't have an indicator. If you're asking about the indicator for this trade, it was the Chandi Momentum Oscillator. You'll see that right over here. And we will be discussing, as a little bit of a teaser, a new indicator that I've never discussed before in this webcast today. So hang in there. It is one of those that can be kind of, I don't know if it's spooky sounding. It's sort of more gross, but I thought it fit the mood of today's discussion. Anyway, we're done with that one. Duke of Foxborough says, Boeing, if you have your corporate showing on a chart, it has. I'll let you finish that comment. I don't quite see what you're saying there. My apologies. But let's have a look at what's going on with the markets. S&P 500 been peeling back, but if we look at it through our study set, now each week we explore new different technical tools, but one way that I introduce continuity from one webcast to the next is we look at the S&P 500 through the same technical lens every week. And that's through our TVM strategy set, trend, value, and momentum. So I'm going to load that up. Our trend indicator is a combination of the 50 and 100 triangular moving averages. Our value is the RSI. Momentum is measured, in this case, by the MACD histogram. So trend still appears to be intact. The 50 triangular is still above the 100. And by the way, if you're not familiar with TVM or these indicators, you may want to go back to those archives that I showed a little bit earlier and just look down through those for the TVM discussion. Oh, okay. Thank you, Duke of Foxborough. Yeah, I didn't have the corporate action. I see what we're saying. Yeah, poor earnings led to the sell-off of Boeing. Yep, we should have been out before then, but that's the way it goes. In this webcast series, we only trade when the camera's on. All right, but our trend here still appears to be intact. The 50 still solidly above the 100. So that's sort of a check for the bulls. That's not very scary. It's not very Halloween-y. Well, look down here at our value oscillator. What do we call this? When the RSI or other oscillators are hitting lower highs at a time when price is pushing to higher highs, our indicator is not confirming what's going on with price. This is known as a bearish divergence. Oh, there we go. Dude, how did I miss that? There was a pun buried in there. Earnings results. It wasn't intentional, but yeah, 747. All right. Yeah, this is known as a bearish divergence. In other words, price and technical performance are diverging. So for some technical traders, an RSI hitting lower highs as price is moving to higher highs may be an indication that there's some underlying weakness that's not otherwise evident in the chart, and it may be forecasting either a shorter term, maybe even a potentially intermediate change to the trend. Now, it doesn't guarantee that that's what's going to happen, but there's our first spooky signal of the day. That's a check for the bears, looking at our TVM method. The third here, if we look at our MACD histogram, typically a bull would be looking for the MACD histogram to be dipping down to lows and starting to rise, getting what I refer to as the red shift, bright red to dark red. When we start to see things get bright green and shift to dark green, it may signal that we're at short-term momentum peaks. The momentum is shifting from the buyers over to the sellers. So that might again be a check for the bears, another potentially spooky indicator. So combination here would be 2 out of 3 kind of falling to the bears. And for the bulls who use this sort of an approach, that might just cause them to pause. Is it going to cause them to panic? I would say likely not. We still have an intact trend. It might be signaling a pause in price optimism. We'll see how that story plays out. But let's use that as a backdrop for our discussion, for our spooky discussion. And actually, Halloween, kind of a dark, spooky holiday. This time of year actually is not terribly spooky overall. It tends to be a bullish time of year, at least if we're looking at longer term trends. But I still want to do something in the spirit of the season. Let's talk about bearishness. Let's talk about spooky charts, ominous charts. So I want to start at a shorter term time frame. Let's look at a few stocks. You're getting scared, the Wired Rabbit? That's good, because I'm not a very good actor. You need to get Ben in here so you can really get people worked up. But let's look at a shorter term indication that might be used by a bearish trader looking for some spooky signals on their chart. And our first example is going to be Tesla. Let's look at the history of Tesla. I'm going to take off our study set here. Let's just remove all these studies and just look at a nice clean candle chart. And I want to focus on these periods where there was a run up and then there's a repeated candlestick behavior. Now, not everybody uses candlesticks, but these are 1, 2, 3, sometimes 4-day price behaviors that a trader observes to see if we're maybe at short-term highs or short-term lows. Are we at short-term reversal points, up at a resistance level or a ceiling likely to go down, or down at a floor or a support likely to go up? In this case, this is one of those spooky, ominous indicators where a trader is looking for a potential reversal of an upward move. So the first qualifier for looking for this indicator. By the way, this is known as a hanging man. Kind of spooky sounding. Kind of bordering on the gory, if you ask my opinion. I'm not the one who named it, so I won't take any blame there. But a pre-qualifier to this, since this is a intentionally spooky sounding indicator, it's intended to signal that we're likely to go down for at least a few days. It's a prerequisite here is for price to move up in advance. So notice before each of these blue ovals that I've created, and if you're wondering where these lines and these ovals came from, I just drew them on there using our drawing tools down here. All right. Wire Rabbit says you dig a candlestick pattern on the chart. Okay. So candlestick patterns are either continuation or reversal patterns. This one happens to fall in the category of reversal, reversing from bullish to bearish. Kind of spooky. Somebody said ghoulish. All right. And actually, this is totally off the topic, but it reminds me of goulash. That's something my mom used to make for me. Anyway, price has been running up in each of these examples, and then it terminates with what's known as this hanging man candlestick. And the construction of the hanging man is a small-bodied candle with a long wick sticking down the bottom. Now, that sounds like I just described a hammer candle, and it really is. The only difference between a hanging man candle and a hammer candle is what happened before. If price has been coming down and we have a small body with a long tail, that's a bullish pattern. If price has been going up, we have a small body with a long tail, that's a bearish pattern. The concept here being, if stock has already been going up, so maybe we could focus on this one, I guess. Stock has been going up and up and up. We open the day at a high. Most of the trading happens below that high, and then we're barely even able to get back up to the break-even area. Maybe a little bit below, maybe a little bit above, but barely to break-even. Does that sound like a lot of enthusiasm for a stock that's already been going up? Probably not. So for some, they see this as a potential spooky signal that maybe price is going to head down again. Sometimes it works. It doesn't always work. But this is the first of our bearish indicators, the first of our spooky indicators, known as a hanging man. Yep, you can see. So small body, long tail. Small body, long tail. Small body here, long tail. There's a small body, long tail. And most recently, there's another very small body, long tail. And we usually don't want to see much of a wick sticking out the top of this. Don't want much trading above the open. That introduces a little bit more optimism to the day's trading. Want to see most of the trading below the day's open. All right, so you can see, I think, why some traders see that as a potential reversal, not a guarantee of performance, but short-term in nature. Let's look at another short-term one. I'm going to switch up now to what's known as a dark cloud cover. Ooh, sounds intimidating. So sometimes these candlestick patterns can be relatively easy to spot. Sometimes it's nice to have a tool to assist with that. Wire Rabbit says, can they be either up days or down days? In other words, can they be green or red? Yep. Yeah. With those hanging man patterns. That's why I say it can get a little bit above the open, maybe a little bit below the open at the close. If we're above the open at the close, that'd be a green candle. Below the open at the close would be a red candle. But yeah, just a small body, pretty much around break even for the trading day. So let's look at this next, still candlestick pattern, still short term. But I'm going to use a little assist here. I'm going to go up to the patterns search tool. Let's turn that on by clicking the box that says show patterns, and let's select a pattern. So specifically for this one, we're going to be looking for the dark cloud cover. So let's go to candlesticks and choose dark cloud cover. How many of you are familiar with the dark cloud cover? Let's apply that to our charts. Click OK. Now what this does is it puts little arrows next to everywhere a dark cloud cover appears, and a dark cloud cover is actually 2 days. So these two in this case, these two in this case. And I would say a trader could also make a really good case for this being a dark cloud cover. And even just over the last 72 hours of trading, that looks like a pretty near candidate. I'll explain why they're a near miss, but for some, they'll fudge the rules a little bit. Still say that's spooky enough. But a dark cloud cover, first of all, it's a reversal pattern. So which way does price need to be going before we'd even apply the label? Price needs to be going up. So notice which way it was going, leading into each of these that the system has identified and that I have identified. And I'll tell you why the system is correct in not identifying these last two, but also why a trader might say, so what, I'm going with it anyway. Okay, somebody says, hey, can I zoom in on this? Absolutely. Yeah, let's zoom in on maybe this one that didn't work out very well. Okay, so first we need to see price going up for a few days. So a dark cloud cover consists of a green candle and a red candle at the top of an up move. The green candle is just a continuation of that up move. Everything's looking hunky-dory, it's looking good. Then the ominous stuff starts. Overnight, there's a gap up. So here's the close of our green candle day. And the gap up at the open of the next day is above the highest point of the green candle. Things are looking great. But then through the most of the rest of the day, it's selling, creating a big red candle that goes down at least through the midpoint of the body of the green. In other words, things start off really good in the morning, but by the close of business, we've given back at least half of the progress that was made by yesterday's candle body. Does that make sense why that could be bearish? And that's sometimes interpreted as a potential bearish, spooky, intimidating, ghoulish signal that sometimes doesn't work out. Look what happened right here. We went down for a day or maybe day and a half, but then started to recover. In this case, maybe the strength of the prevailing trend prevailed. Well, let's look at the next one. Zoom out. Here's our next one. In this case, price is going up nicely. We have a nice big green candle. Everything's looking good. Ooh, it's looking even better. Overnight gap up. Things are very strong. And then the selling starts, and we get down past the midpoint of this middle of the middle of that previous candle. And in this case, what happened in the subsequent days? Yep. In this case, this turned out to be a pretty good quality signal. Let's look at what's happening recently. It's going to be the same story with this one and this one. Nice moves up, green candle, red candle, everything looks like it's qualified. Here's where the system said it didn't quite make it. And this is where the Y-Rabbit says, Cam, the patterns can be tweaked, right? You mean the pattern search or the pattern itself? Yeah, there can be different interpretations of this tool or of this approach, if that's what you're asking. In this case, I think that there'd be a good number of traders that would say, you know what, this one's close enough. It's not technically qualified to be a dark cloud cover, and it's called a dark cloud cover because well, I didn't explain why the last one's called a hanging man. It's because it has sort of a head with I'm sorry, it's gross. It's the visual, I guess, that the creator or the first namer of the indicator decided to go with. But with a hanging man, just a small body think of the long tail hanging down. That's unfortunately when you're hanging, your arms and your legs are hanging straight down in a line. Anyway, there you go. This one's not quite so morbid. In this case, it's kind of like the clouds have settled in. We have everything's sunshiny, and then the cloud moves in. But what would disqualify this one? Well, here's what the system nitpicked correctly. We have the upward move, we have the big green candle, we have the big red candle, but the opening price of this red candle was not above the previous day's high. It was, in this case, it was slightly below. Does that mean that this is not bearish? No, it just means it doesn't technically qualify for this label. All right, for some traders, they'd say, go ahead with it anyway. And so far, so good for a trader who maybe bit on this signal. All right, so that's spooky indicator number 2. Both of those are kind of short term. Let's move on. Instead of looking for just a few days worth of signal, maybe moving on to days to weeks. This is moving toward the intermediate range. And for this purpose, some traders will use an oscillator. It's an indicator that shows up down below the chart. So let's clean things up here. I'm going to switch to a different chart, and I'm going to use General Electric for this one. And I told you we're going to give our chart an ulcer, and I meant that literally, not like we're going to give it stomach acid, but there is an ulcer index created and named to identify when traders might be getting most anxious. And really, this was built to measure what the creator called downside risk. Interestingly enough, in the 40 years since this was created, the sort of a different approach has been adopted for trading this indicator. But let me just apply the ulcer index to the chart, and I'll explain briefly how it's built. This is getting kind of deep in the weeds. I'm not going to spend much time on it, but there's a bit of an algorithm here to measure what's called the downside risk. It measures both the depth and the duration of downside moves on a stock chart. And then for some traders, they use that to gauge how big has the ulcer grown. Interestingly, the original intention here was to say, hey, when this is spiking, there's a large downside risk and maybe stay away from the stock. Some traders have shifted to exactly the opposite approach. When the ulcers are big, when everybody else is worried, when the selling has been particularly strong, to some they see that as a buying opportunity, and they'll look to spikes in this indicator as a potential for entry, not bearishness. So maybe not as spooky as the original author intended. But so here's the construction. If you want to know the algorithm, I wrote it out as plainly as I could for myself so I could explain it as clearly as possible. Basically, 3 steps I was able to summarize it in. First of all, we calculate something known as the percent drawdown, and it is just what it implies. We look at a given period. In this case, you'll notice the numbers 14 and 5, but this looks over the last 14 days, and it just looks at where did we close today, and how does that compare to the highest close in the last 14 days? And what percentage have we dropped since that highest close? So it takes today's close, subtracts the high of the 14-day period, divides that by the highest close, and then multiplies that by 100 to give it a percentage. That's it. You may need to go to the archive if you want to really follow along with what I just said, if you want to take notes or whatever. You can just go watch the recording of this. I decided not to take the time to write it all out. I'm just going to have to say it verbally, just in the interests of time. But step number 1 is to calculate that percent drawdown. That was the easy part. Next, we determine something called the squared average, which is we take a 14-day sum of those percent drawdowns. So we look at the percent drawdown today, percent drawdown yesterday, and ... back 14 days. Add those all up, divide them by 14. And then, we add those all up. Skipped a step here. Add those all up, square that, and then divide by 14. So that's step number 2. And then step number 3, to get the ulcer index, we take the square root of the squared average. You're welcome. That's what it's doing. But in any case, really what we're doing here is applying sort of a weighted average to recent drawbacks over the last 14 days to measure their depth and to measure their duration. And then there's a line drawn here at 5. There's a significance to 5. So it says 14 and 5. When we see our UI line cross up above 5, it means that the recent drawdown has been particularly strong and particularly long, and this would be considered to have strong downside risk. Interesting. But for some traders, that actually may put them on alert. There may be a buying opportunity ahead. When everybody else has ulcers, maybe that's when we need to have an iron gut, and when the trader might be looking for an entry opportunity. Does that sound like a relatively straightforward, logical approach? Could be. It's not a guarantee of performance. But for some traders, what they'll look for is this period of what they call, what the original interpretation would be elevated downside risk. But when that starts to reverse, when the UI line starts to move down, having already crossed up above 5, everybody else is full of ulcers. But maybe that means that the selling has reached an exaggerated peak and possibly there's an entry opportunity. That's not very scary, right? Paul says, buy when there's blood in the streets. Okay, I guess I can allow that for Halloween if we're talking about movie set blood, right? Okay. But yeah, you can see here, the indicator reached a peak. There was actually, no, this wasn't a terrible signal right there, but another one right here. And you can see price actually performed fairly well when the ulcers were at their strongest. There was one right here, very small, but we did get above 5 and then started going back down again. Did a pretty good job of anticipating an upward move. Doesn't always happen that way, but with General Electric, there are a pretty fair number of examples. Here's one that failed. Okay, here's one where the trader might have said, hey, time to get excited. And nope, the stock misbehaved for several more weeks. So no indicator is perfect, but there's your ulcer index. All right, so I think this has been fun. We've moved from short term to a little bit intermediate. You can see that these will tend to play out for possibly a longer period. Sometimes a trader will even use these to try to optimize, even if they're an investor and they're looking to get in for a longer time frame and they're just trying to get a little bit better fill. This is one of those indicators that might be used toward that end. None is a guarantee that it's going to improve things, though. Now, let's move on to a longer term indicator. And I think our veteran traders here in the audience know that for a longer term, we might look at price over a longer period and use things like trend lines. So that's what we're going to be using for our last example. Let's come up here. Let's take off our Ulcer Index. And I'm going to go to what tends to be kind of a crowd pleaser, I guess. It's a very popular indicator that I'm certainly not unique in discussing. You've probably heard about this one before. I teased it at the outset. We're going to be talking about something known as a death cross. Very much in keeping with the season, with the theme for today. But let's look at, how about we look at Kroger? For Kroger, I'm going to look at two trend lines. One that's a little bit intermediate, another one that's possibly longer term. A death cross is looking at the interplay between two trend lines of different lengths, intermediate and longer term. Now, most commonly, this would be a 50-day compared to a 200-day trend line, or a 10-week versus a 40-week. Those are almost the same thing, because how many days are in 10 weeks? There are 50 days in 10 weeks, roughly. How many days are in 40 weeks? Roughly 200 days. So using a 1040 week or a 5200 day, pretty similar, not identical, but close enough for most practical purposes. But let's come up here and add two of these trend lines to our chart. And I'm just going to be using simple moving averages. Let's add two of them. The first one, we're going to be making our intermediate trend line, looking at 50 days worth of data. That one's going to be a little bit faster. Let's give it a little bit hotter color. Let's go for the red. And for our longer term trend line, we're looking at 200 days worth of data. This one we're going to make green. However, I recognize some people can't visually see the difference between red and green, so let's also make this one a little bit thicker. So the thicker one's going to be our longer trend line. So I'm going to click on OK, click Apply, and click OK again. And so here are our trend lines, and here's the concept of what's known as a death cross for the bears in our audience, for the bears among the traders who are looking for a stock that's showing some significant weakness. By the way, there's an arrow right there. What happened right there? Dark cloud cover. I don't need those right now. Let's clean things up. I don't need to show the patterns. Let's just take that off. All right, but a bear might be looking for, conceptually, prices that have been going up but are starting to show signs of weakness, where an intermediate trend is turning. And even if over the longer term things are still looking comparatively rosy, the intermediate is coming down, maybe applying pressure to the longer term, and possibly we could see things reverse over a longer period. So that 50 period moving average representing our trend line here, and there can be other uses for moving averages. They can, for example, maybe be used as areas of support, like here and here. They could possibly be used as areas of resistance, but trend lines is another common application. When we see our 50-day moving average cross down below the 200-day, that might imply that our intermediate trend has gotten so weak, it's applying downward pressure now, and maybe it'll even drag down our longer term trend. And that can be a bearish signal to a trader. And you can see that's actually happening pretty much as we speak. Let me put my cursor right on today. I want to look. You can see the absolute values of both of them right up here. So I'm going to point it today, and I can see that my 50 is at 67.29. Our 200 is at 67.33. So literally just fractions of a point, we've slipped below that 200. So this is known as a death cross. Dramatic sounding name, but it's just intending to paint a specific image, I guess, which is this looks bearish for the stock. Now, it's nice that I knew that Kroger was having a crossover, but how in the world do we find a crossover? They don't actually happen very often. If you look at this chart, we haven't seen a death cross all year. And as a matter of fact, if we switch it up, let's switch our time frame from 1 year ago. Let's go to 2 years. We haven't seen, this is interesting. That should be filled in. Don't know why that's I haven't seen that before. Kevin, throw me a bone here. Yeah, I don't know why the Kroger is only showing. There it is. It filled. It was just thinking. Okay. Anyway, we haven't seen a death cross even in the last 2 years. What do we call this when the intermediate trend has been underperforming the long term, but then it starts to strengthen, it crosses above? Just to throw a little bit more light into this discussion, this is known as a golden cross. Mystic DAG says, is the simple moving average by day or by time frame? Yeah, so this, I'm looking at a daily chart, and so therefore, this is a 50 versus a 200-day moving average. If I switch this to, let's say, an hourly chart, it would be the last 50 hours compared to the last 200 hours. Yeah. Yeah, this is known as a golden cross. Ooh, sounds like I'm the leprechaun at the end of the rainbow. It's not a guarantee that things work out. In this case, it did. It doesn't always. Somebody who just really had a flair for the dramatic in the naming of these things. But let's go find another death cross. How could we find those? Well, there's a search function within the live platform of Thinkorswim. This is paper money. Can't find it there. I'm going to switch over here to the live platform. I changed my color scheme on my live so I can tell the difference. But let's go to the scan tab, and I'm going to run a quick scan. And it's going to be purely technical, so I don't need any of these stock filters. Let's just take these out of the default scan. And instead, I'm going to add a study or a technical filter. Now, in this case, we're going to go to a custom filter. There's a reason for this. I actually can look for crossovers. There's a default crossover scan, but it only looks at what's happening today. I want to look back over the last few days, so I'm going to make this a little bit more custom. All right, first thing I need to do in this custom, let's just delete ADX crossover. That's the default, just the first one in alphabetical order, and we're not going to be using that. Instead, let's add our own condition, and that is going to be a comparison of two studies. So we're going to choose, it's going to be a study, a simple moving average, and specifically the 50 crossing below another study, simple moving average. We're going to have that crossing below the 200, not just today or within the last one bar, but let's say over the last 3 days. Let's click Save, click OK, and let's run this just through the stocks comprising the S&P 500. We could look through all stocks. I'm just going to look at the S&P 500 component companies, see how many of those may have had a death cross within the last 3 days. So let's run a scan here. And I know there's one that should be showing up here. Hey, there's Kroger. Guess how I found Kroger today? Yep. Berkshire Hathaway. There's Philip Morris. Let's see what's going on with Philip Morris. Hey, what do you know? Ooh, that's awfully close, isn't it? This had a golden cross back there about the same time as Kroger. And let's go a little bit closer. How about we look at maybe the last 6 months so we can get a closer view of that? Can you see that red line just now dipping? Probably actually had its crossover maybe yesterday, but definitely today. 159.28 versus 159.63. That is a death cross. And so a trader who's bearish here may take that as an entry signal and then wait to see, do we get a subsequent golden cross and get out then? But guys, with that, that's enough. I think that was a little bit dramatic, a little bit spooky. I like one. It's kind of, I like it, talking about some of the kind of weirder names out there. Yeah. Hanging Man, Dark Cloud Cover, the Ulcer Index, the Death Cross. If that set the stage for Halloween fans in the audience, then glad. I hope this was a fun one, guys. It's time for me to let you go. Go enjoy your Halloween. Kevin, thanks for helping out in chats. I do have a couple of suggestions for you before you go, though. Let's make sure that you're aware of all of the resources you have from the education team here at Schwab. Number one is make sure that if you haven't given us a subscription, if you haven't subscribed to our Trader Talks channel on YouTube yet, do that right now. It doesn't cost anything. You just go down below the video stream, click on the subscribe button. It literally only takes a second. But this is where we house our live streams, but also our previous webcasts. So You can find the playlist for this webcast series by clicking on playlists and finding it in that group. Another thing you could do, if you saw something in one of my webcasts and you think, what was Cameron talking about? TVM. Hey, let's look at TVM. Understanding the trend value momentum chart trading system, that one that we just used on the S&P 500. So check that out. Another suggestion that I have for you is to follow us on social media. You can follow Kevin and me on X if you have an account on X. You can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. And if you reply to one of my posts, I try to reply right back to you. Like, for example, I just posted this morning an observation about NVIDIA. They just made a $1 billion investment, or announced a $1 billion investment in Nokia. Well, $1 billion sounds like a lot of money, but NVIDIA a couple of days ago hit $5 trillion. It's the first $5 trillion company in the world, $5 trillion market capitalization. And then I asked this question: how long do you think it will be before we see the world's first $10 trillion company? Can NVIDIA double? That would do it. I don't know if it will or not. We'll see. Can someone else sneak up past, leapfrog NVIDIA? Do you think that's going to happen in a year, in the next 5 years, or is it going to take longer than that? So that'll be interesting. I'll have a discussion there with my followers. Not a recommendation of, obviously, of NVIDIA, just an observation. But also, I want to let you know that I'm now on LinkedIn. Great advantage of connecting with me here on LinkedIn is that I can do longer form stuff on LinkedIn. So, like, for example, just this morning, I posted a video, nice little 8-minute video, introducing the stochastic distance oscillator, which we actually discussed a few weeks ago in this webcast series. Gave a little breakdown of what that video is and linked to that video. Previously, I've also discussed this NVIDIA Nokia agreement. And as replies come in here, I try to reply back to you there as well. All right. So that's really nice. Couple of different ways to connect with me now. So follow me on both platforms if you have that ability, one or the other, if that's your preference. But everybody, time for me to let you go. Go enjoy your Halloween. Have a great holiday. I will see you on Monday. Kevin, thanks for helping out in chat. I'll look for you in a future webcast. I'll look for you on X. I'll also look for you on LinkedIn. But wherever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.